In this exercise, we're going to journalize some transactions related to inventory and accounts receivable. Here we have 3 transactions related to Albatross Company. Our first set of instructions are to prepare journal entries to record these transactions on the books of Albatross Company, and Albatross Company uses a perpetual inventory system. To help us out, we'll also include the accounts receivable account from our general ledger. Let's look at our first transaction. On March 3rd, Albatross Company sold $250,000 of merchandise to Siegel Company terms 210 net 30, and the cost of merchandise sold was $200,000. The terms 210 net 30 mean that if Siegel Company pays off their account balance in 30 days, they will receive a 20% discount. So for March 3rd, we're going to debit accounts receivable for $250,000 to record the sale. We'll credit sales revenue for $250,000. Remember, with any selling transaction, there's going to be 2 sets of entries, one to record the sale and one to record the cost of goods sold. In this case, $200,000 worth of merchandise was sold, so we'll debit cost of goods sold for $200,000 and credit inventory for $200,000. At this point, you'll notice that our accounts receivable will have a debit balance of $250,000. On March 8th, Siegel Company was granted an allowance for $15,000 of merchandise that was purchased on March 3rd. Now, this allowance was likely because there was either defective merchandise or they were unsatisfied with the product they had purchased. So on March 8th, we're going to debit our sales returns and allowances account, which is a contra asset account, for $15,000, and we're going to credit accounts receivable for $15,000. which reduces our accounts receivable balance now to $235,000. Finally, on March 13th, Albatross Company received the balance due from Siegel Company. So we'll record this transaction for March 13th by debiting cash and sales discount and crediting accounts receivable. We'll begin with our accounts receivable. Since we know we have a debit balance of $235,000 in our accounts receivable, we'll credit accounts receivable for $235,000 to bring our account balance to 0. Our sales discount will be 20% of the remaining $235,000 in our accounts receivable. So we'll take $235,000 and multiply it by 20% to get $47,000 for our discount. The cash we receive will be the difference between our accounts receivable and our sales discount. So we receive $188,000 in cash. Part B of this problem asks us to change our assumptions. We assume that Albatross Company received the balance due from Siegel Company on April 2nd instead of March 13th. So we'll prepare the journal entry to record the receipt of this payment. Because April 2nd is outside of the 30-day window, it will not receive the 20% discount. So for our transaction on April 2nd, we're going to debit cash for the entire balance of our accounts receivable, $235,000, and we'll credit accounts receivable for $235,000, which will zero out our accounts receivable account.